Governor of Nevada PANICS after downtown Vegas condos crash. Something unprecedented is unfolding in downtown Las Vegas right now, and the silence from officials is deafening. While the Nevada governor's office scrambles behind closed doors, thousands of condo owners are watching their American dream dissolve into a financial nightmare that nobody saw coming. This isn't speculation. This isn't fear-mongering. This is a meticulously documented market collapse happening in real time, and the numbers are absolutely terrifying. November 2025 marks a pivotal moment in Las Vegas real estate history. What you're about to hear will fundamentally change how you view the glittering promise of downtown urban living. Because beneath the surface of champagne toasts and ribbon cuttings lies a catastrophic convergence of factors that has trapped thousands of investors, homeowners, and families in properties they can neither sell nor afford to keep. The first shockwave hit in April 2025, when inventory numbers crossed a threshold that sent analysts into emergency meetings. Downtown Vegas condo inventory didn't just increase. It exploded by 91.5% year over year. Let that sink in for a moment. In just 12 months, active condo listings surged from approximately 1,200 units to 2,300, and 90 units sitting unsold on the market. That's nearly double the supply in a single year. But here's where the situation transforms from concerning to catastrophic. While inventory nearly doubled, actual sales plummeted by 12.4% compared to the previous year. Think about the mechanics of that equation. Twice as many desperate sellers competing for a shrinking pool of buyers. This isn't a correction. This is a market fundamentally breaking down at its core. Every economic principle screams that prices must collapse when supply explodes and demand evaporates simultaneously. Yet somehow, listings remain stubbornly high while owners bleed cash every single month, paralyzed between denial and financial ruin. The crown jewels of downtown's promised renaissance are now ground zero for this unfolding disaster. The Jewel, the Ogden, Soho lofts. These weren't just buildings. They were symbols of a vision that captivated investors nationwide. The late Tony H.C., the Zappos visionary, poured $350 million into transforming downtown Las Vegas into a vibrant urban ecosystem. His downtown project promised to create a walkable, livable, thriving community that would rival Brooklyn or Austin. People believed. They invested. They bought into the dream with their life savings. Tony H.C. is gone now, tragically passing in 2020. And with him went the momentum, the vision, the capital infusion that kept the dream alive. What remains are dozens of high-rise towers filled with owners who are now discovering that dreams don't pay mortgage payments and visions don't cover homeowners' association fees. Let's examine the Jewel specifically, because this building encapsulates everything that's going wrong. Right now, at this very moment, the Jewel has 24 active listings sitting on the market. Prices range from $242,000 for smaller units up to $699,000 for premium penthouses. 24 separate units in one building, all competing against each other, all desperately seeking buyers who simply aren't materializing. The median sale price hovers around $477,500, which initially sounds healthy for a luxury downtown property. But here's the devastating reality that listing websites don't show you. In the last 180 days, only 6 condos actually sold in the Jewel. 6 sales, out of a building containing 341 total units. At this sales velocity, it would take over 10 years to sell just the current active inventory in that single building alone. And that's assuming no additional owners decide to list their units, which of course they will as financial pressure intensifies. This isn't a market. This is a slow-motion financial implosion captured in spreadsheets and listing data. The broader high-rise market reveals the same disturbing pattern repeating across every tower. Total sales in the Las Vegas high-rise condo market hit 604 transactions in 2024. That number represents an 18% decline from the 736 sales recorded in 2023. But that 2023 figure was already down from 944 sales in 2022. We're watching a mathematical death spiral. The peak occurred in 2021 with 1,159 sales, driven by pandemic-era FOMO and dreams of Airbnb riches. We're now at barely half that volume. Half. The velocity of transactions has collapsed while inventory has exploded. Anyone with basic economic literacy understands what comes next. Now we need to discuss the financial weapon that's silently destroying these condo owners month after month after month. The Homeowners Association fees. These aren't the $100 or $150 monthly fees you might encounter in a suburban townhome community. Downtown Las Vegas high-rise HOA fees range from $400 on the absolute low end to $900 monthly for standard units. Premium units are getting hammered with $1,200 monthly assessments. Some luxury penthouses are pushing $1,500 per month just in HOA fees alone. Let me walk you through the mathematics of ownership, because the numbers reveal why this market is imploding. Imagine you purchase a $400,000 condo in downtown Las Vegas. You put down 20%, which is $80,000 in cash. At current mortgage rates around 7%, your principal and interest payment comes to approximately $2,130 monthly. Add $900 in HOA fees. You're now at $3,030. Property taxes add another $330. Insurance contributes $100. Your total monthly obligation for a 2-bedroom downtown condo is $3,460. Here's the gut punch that's waking people up. For that same $3,460 per month, you could rent a beautiful single-family home with a yard in Summerlin or Henderson. No HOA drama, no special assessments, no restrictions on how you use your property. The value proposition has completely evaporated. The short-term rental apocalypse delivered the killing blow to investor dreams. During the pandemic buying frenzy, thousands of investors purchased downtown condos with a simple business plan. Buy the unit, furnish it nicely, list it on Airbnb, and watch the Vegas tourism machine generate cash flow to cover the mortgage and HOA fees while building equity. It seemed foolproof in a city that attracts 40 million visitors annually. Then the hammer dropped. Building after building banned short-term rentals entirely. The Jewel, the Ogden, Soho lofts, practically every major downtown tower implemented blanket prohibitions on Airbnb, VRBO, and all short-term rental activity. The homeowners associations grew tired of the constant stream of tourists, the noise complaints, the security concerns, the wear and tear on common areas. So they voted to ban the practice that was keeping their fellow owners financially afloat. The city of Las Vegas itself estimates there are approximately 10,000 active Airbnb listings currently operating across the metro area. Yet only 4,000 short-term rental permits have actually been issued by the city. That means 6,000 listings are operating in legal gray zones or outright illegally. The crackdown is intensifying. Downtown condo associations are leading the charge, and owners who built their entire financial model on short-term rental income are now trapped. These investors cannot make their numbers work with traditional long-term rentals. A 2-bedroom downtown condo might rent for $2,200 to $2,500 monthly in a long-term lease, but the owner is paying $3,000 to $3,500 in combined mortgage and HOA obligations. They're losing $500 to $1,000 every single month they own the property. Selling means taking a significant loss after accounting for realtor commissions and closing costs. So they're stuck, hemorrhaging cash, desperately hoping something changes. If you're finding this deep dive into the Vegas condo crisis valuable, do me a favor. Hit that subscribe button right now so we can reach 1,000 subscribers. This kind of in-depth real estate analysis takes serious research, and your subscription helps us continue exposing the stories that mainstream media won't touch. Subscribe, and let's grow this community together. Applied Analysis, a leading Nevada research firm, tracks 21 high-rise towers across Las Vegas. Their data reveals the current average listing price sits at $989,560. But average listing prices mean nothing when nobody is actually buying at those prices. The critical metric is days on market and sale velocity. Currently, only 52.9% of listed condos are selling within 30 days. Last year, that figure was 66%. The market is slowing, freezing, seizing up. Half of all listed condos now sit unsold for over a month. In Las Vegas, a city supposedly experiencing explosive growth and expansion, properties are languishing unsold for months. Nevada holds an unenviable distinction. The state ranks number 1 in the entire nation for foreclosure rates. 1 in every 2,326 housing units in Nevada is currently in some stage of foreclosure. That's more than double the national average. And when economic pressure intensifies, which property type collapses first? The answer is always the same. Condos with massive monthly obligations and limited buyer pools fail first and fail hardest. Right now, at this moment, there are 244 condo foreclosures actively listed across the Las Vegas metro area. These are properties where owners have completely given up, where the bank has taken possession, where the American dream has officially died. But the truly desperate sellers are the ones still trying to avoid foreclosure. Drive through downtown and you'll see signs everywhere screaming, "Seller financing available," and "Owner will carry." When individual sellers are forced to become the bank because actual banks won't touch these properties, you're witnessing the final stages of market collapse. Let's examine the Ogden, which was supposed to be the flagship of downtown luxury living. In the entire year of 2024, the Ogden recorded exactly 20 sales, 20 transactions in a building containing hundreds of units. The average sale price was $487,863, with a price per square foot of $347. That sounds almost reasonable until you factor in the $800 monthly HOA fee that never stops, that increases regularly, that will hit you with special assessments when the building needs major repairs. Current Ogden listings include a 3-bedroom unit priced at $549,000, with seller financing prominently advertised. The owner is so desperate to escape that they're willing to carry the note themselves, taking on all the risk of buyer default. That's not a sign of market strength. That's a distress signal. Soho Lofts recorded 8 sales in 2024. 8. Newport Lofts managed 7 sales. Metropolis celebrated 6 sales as growth because they only had 2 sales the previous year. 6 sales in a building with over 300 units. These aren't functioning markets. These are ghost towns with occasional transactions that make the statistics slightly less apocalyptic. The truly terrifying aspect of this collapse is the timing. This is all happening while Las Vegas is supposedly booming. Unemployment stands at 5.4%, which is practically full employment. People are still relocating to Nevada for the no state income tax and lower cost of living compared to California. The Raiders brought an NFL franchise. Formula One Racing created a spectacular annual event. Major corporations are opening offices. By every traditional metric, Las Vegas should be thriving. Yet the downtown condo market is dying. If condos are struggling this badly during good times, what happens when the inevitable recession arrives? What happens when unemployment spikes, when discretionary income evaporates, when distressed sales accelerate? MGM Signature recorded 79 sales, because it operates as a condo hotel where owners can still participate in nightly rental programs. Trump Tower had 66 sales for the same reason. These properties maintain the investment value proposition. But pure residential towers where you cannot generate short-term rental income are being systematically abandoned by investors. Park towers, positioned as ultra-luxury, managed just 7 sales all year at an average price of $1.54 million. When your annual sales volume is 7 units, average prices become meaningless statistics. The financing disaster is strangling the market. Most downtown condo buildings lost FHA approval years ago, which means buyers cannot access government-backed loans with low down payment options. Many buildings also lost Fannie Mae and Freddie Mac approval, eliminating conventional financing for vast numbers of potential buyers. Purchasing a downtown Vegas condo now typically requires 20 to 30% down payment in cash. For a $400,000 unit, that's $80,000 to $120,000 upfront. In a market where the median buyer is already stretching to afford anything, demanding massive cash down payments eliminates entire demographic segments from your buyer pool. One downtown building is actually advertising rare Freddie Mac approval as a major selling point. When basic access to normal mortgage financing becomes a marketing gimmick, a unique feature worth highlighting, the market is fundamentally broken. Distressed sales currently represent less than 1% of closed transactions. But that's a lagging indicator that masks the crisis building beneath the surface. Notices of default, the first stage of foreclosure, are up 28% year over year. These notices are concentrated in lower-income zip codes where owners are most vulnerable to economic shocks. Those default notices take 4 to 6 months to become actual foreclosures. They're in the pipeline right now. The wave is building. The average price per square foot downtown currently sits at $382. With 4.4 months of inventory and climbing, that number is going to crack. The traditional real estate rule says anything over 6 months of inventory creates a buyer's market where prices decline. We're already at 4.4 months with inventory doubling annually. We'll be at 6 months within weeks. When we hit 8 or 9 months of inventory, which is mathematically certain at current trends, the price floor will collapse. Sellers are beginning to realize they're not just competing against other buildings or neighborhoods. They're competing against dozens of nearly identical units in their own building, all listed simultaneously, all desperate to sell. The race to the bottom is inevitable. The jewel perfectly illustrates this internal competition. Units range from $242,000 to $699,000 in the same building. That's almost a 3x spread within one address. What does that do to buyer psychology? It creates paralysis and extreme price sensitivity. Sky Las Vegas recorded 28 sales in 2024 with an average price of $696,579. The building is beautiful. The location is good, but HOA fees exceed $1,000 monthly for a one-bedroom unit. At that price point, you're paying $12,000 per year just for HOA fees. Over a 30-year period, that's $360,000 in pure HOA assessments, assuming no increases, which is laughably optimistic. The Waldorf Astoria averages $3.39 million for its 21 sales, but here's the catch that destroys investment value. Only original purchasers who bought directly from the developer can participate in the hotel rental program. If you buy a resale unit, you're locked out permanently. You're paying $3 million plus for a condo you cannot rent out short-term. You're purely betting on appreciation in a market where prices are clearly topping out. Las Vegas high-rise condo sales peaked at 1,159 transactions in 2021. That number dropped to 944 in 2022, then 736 in 2023, then 604 in 2024. That's a 48% decline from peak in just 3 years. The trajectory is clear and accelerating downward. Demographics are creating a perfect storm of negative pressure. California retirees on fixed incomes are being driven away by HOA fees that consume significant portions of their monthly budgets. Young professionals cannot qualify for 7% mortgages, with 20 to 30% down payment requirements. Investors have completely exited after the short-term rental bans eliminated their business model. Who exactly is the target buyer for these properties? Here's the crisis nobody is discussing publicly. These buildings are aging into major capital expenditure cycles. Downtown towers are 15 to 20 years old now. They're approaching the phase where elevators need replacement, HVAC systems require complete overhauls, roofs need to be redone, parking structures need repair. Where does that money come from? Special assessments levied against all unit owners. Imagine you're already struggling with a $900 monthly HOA fee. Then you receive notice of a $20,000 special assessment due in 90 days to cover emergency repairs. That special assessment will trigger forced sales, foreclosures, and absolute panic. The absorption rate for high-rise condos now stands at 12.48 months of inventory. That means at current sales velocity, it would take over a year to sell all existing inventory, even if not a single additional unit was listed. Some individual buildings have 18 months of inventory. One Las Vegas recorded 19 sales at an average price of $437,863. 19 sales out of almost 800 total units in the building. At that rate, it would take 42 years to turn over the entire building through sales. While condo owners watch values stagnate and mail monthly checks to HOA accounts, single-family homes in Las Vegas are still appreciating at 2 to 3% annually. Condo owners are not just losing money on carrying costs. They're missing out on appreciation happening in neighborhoods 10 minutes away. The opportunity cost is staggering. Downtown Vegas bet its entire future on becoming the Brooklyn of the West, an artistic, walkable, urban paradise where young creatives and professionals would flock to live car-free lifestyles. But Brooklyn works because it's connected to Manhattan by subway. Downtown Vegas is an island surrounded by sprawling suburbs and desert. You cannot build a sustainable condo market on art galleries and coffee shops when HOA fees cost more than luxury car payments. Real estate agents with decades of experience report that buyers are walking away from deals at record rates the moment they hear HOA numbers. One couple fell in love with a jewel unit, perfect views, great layout, ideal location. Then the agent mentioned $850 monthly HOA fees. They literally laughed and walked out of the showing. That reaction is becoming standard. So what's the bottom line on downtown Vegas condos? Prices haven't technically crashed yet. Most recent sales are still slightly above last year's numbers, but every single leading indicator is flashing red. Inventory doubled. Sales are falling off a cliff. Days on market are rising. HOA fees are crushing affordability. Short-term rental bans eliminated investor demand. Foreclosure notices are climbing 28% year over year. This market is the Wile E. Coyote moment. It already ran off the cliff. It just hasn't looked down yet. When sellers finally capitulate and begin aggressively cutting prices to generate any sale at all, the cascading effect will be brutal. We're looking at a market that doubled inventory while sales dropped, where monthly carrying costs can exceed $3,500, where you cannot even use Airbnb to offset expenses. The downtown Vegas condo dream is transforming into a leveraged nightmare. Mark this prediction. By November 2026, exactly 1 year from now, we will see price reductions of 20 to 30% on downtown towers. The smart money is already selling and rotating into single-family homes in Summerlin or Henderson. No HOA drama, No special assessments. No rental restrictions. No competing against 24 identical units in your own building. Before you go, drop a comment below. Are you a Vegas condo owner? Are you watching this market from the sidelines? What do you think happens next? The comment section is where the real insights emerge, so share your perspective. And if you haven't subscribed yet, what are you waiting for? We're building a community that sees through the hype and focuses on data. Click subscribe. Downtown Vegas condos are done. The crash isn't coming. It's already here. It's just happening in slow motion, one desperate seller financing sign at a time. Don't say you weren't warned.